I'm sure a lot of you are aware that the Fed just cut interest rates here a couple of weeks ago. I got emailed this very, very interesting piece by a good friend of mine and consultant that we work with quite a bit that showed us what historically cash and bonds and stocks have done 1 year after the Fed starts to cut interest rates. I thought this was very interesting. Now, one of the things that I will say is I cannot predict the future. I don't even have a crystal ball, but I thought this title might catch your attention a little bit. So I apologize for the lost leader. Anyhow, let's take a look at this visual together. So here's what we're looking at is over here in this area, you can see that 1 year after the Fed starts cutting interest rates, that typically bonds actually do really well. And sometimes stocks don't do as well as bonds. However, we don't invest for the short term, we invest for the long term. In this section here, you can see what it looks like 3 years after historically the Fed has cut interest rates. That cash is doing about 4%, bonds are at 8%, and stocks are at 12%. Well, you can see that the further out you get from a Fed rate cut, that not only stocks do better than bonds, but bonds do better than cash. What's my point here? I'm kind of trying to drive home this idea that if you are in the camp that getting 4 or 5% on your CDs and 5% on your money market feels really good, it's probably going to be a temporary feeling. So just like I reiterated last week, if you've got money sitting in CDs or money market, that very well could be a good spot for it. However, we should always have a discussion about how much you have and how much you might need to have. Oftentimes we're finding people are letting their comfort of those high interest rates lull them to sleep by keeping too much in those accounts. If you've got specific questions about your own circumstances, please reach out to us. Hope you're well. Talk to you soon.